Hi everyone, thank you for joining us. My name is Lori Norman. I'm an investor specialist and partner with Steadyhand. Joining us today is Carolyn Kwan, a portfolio manager and partner with Connor Clark & Lunn, and Tom Bradley, Steadyhand's chair and chief investment officer. In today's segment, we'll discuss interest rates and bonds. With bond rates historically low around the world, many investors, understandably, are questioning the role of bonds in their portfolio and what to expect from their fixed income returns going forward. Carolyn, welcome. Let's start with a big topic. Can you tell us and remind us why interest rates are so important?
Thanks, Lori. Well, yes, interest rates are crucially important. They affect just about every facet of the economy, whether you're a saver or a borrower. And what we want from interest rates, be it high or low, depends very much on what part of our life cycle we're at and where we are and what we're trying to achieve. As for a portfolio, though, interest rates do have a very important impact on a wide variety of asset classes and, very critically, bonds. When we buy a bond, what we're doing is lending money. We would lend money to someone else, a business or a government, and that other person has an obligation to pay back that amount plus interest along the way, and that interest is known as the coupon. In fact, there's another component of bonds which is just as important, and that's a capital appreciation or capital depreciation that can happen. Let me try to explain with an example. Interest rates do move up and down every day due to changes in the macroeconomic backdrop. And suppose you own a bond that pays interest at 4%. And then if interest rates decline to 3% over the course of the time, then suddenly the bond that you own is more valuable. And so the price of the 4% bond will actually rise in value until it's like an investor that would yield 3%. And the argument works in reverse as well. If interest rates were to rise to 5%, that original 4% bond becomes less valuable. Bonds in any portfolio are valued on a day-to-day basis, so the portfolio will grow or decline in value, much as your equity portfolio might. But the key point is that interest rates and bond prices move in opposite directions. As interest rates go down, bond prices go up. And as interest rates go up, bond prices go down. Actually, a great example of this, of what the different parts of a bond portfolio will do to returns, happened in 2020. Interest rates went down a lot, and so the coupons on the bonds did not provide very much return. However, what has fueled bond returns was actually prices rising. Bonds, in fact, returned just under 10% for the portfolio for the year as a whole.
Carolyn, I can confidently say that the 10% return surprised many of us, and the declining and low interest rates helped. But with interest rates at virtually zero now, what does that mean for returns? And maybe you can talk through some strategies that Connor Clark is using.
Right. Well, there are, in fact, a number of tools that a bond manager can use. We make decisions every day on behalf of our clients, and we have a number of strategies that we can employ to take advantage of movements in markets. And I can go over a couple of examples here. The first one being interest rate decisions, and another being managing credit. So in terms of managing interest rates, I explained earlier that bond prices go down when interest rates go up and vice versa. And what we do is try to earn money not just from the coupon of a bond, but by buying and selling bonds in the marketplace before they mature. And how is that? Well, one way we do that is anticipating whether interest rates will actually rise or fall over the next few months. Every bond, and there are bonds that exist from 1 year out all the way out to 30 years and even further, every bond has a different sensitivity to the changes in interest rates. How sensitive a bond price is to a change in interest rates is a concept known as duration. And it depends critically on the length of time until a bond matures. The longer the maturity, the more sensitive it will be to interest rates. And in fact, a seesaw graphic, if you think about seesaws like kids play on, it's one of the most intuitive ways I've actually found to describe or understand the concept of duration. So if you anticipate that interest rates are going to decline and bond prices are going to rise, you want to extend your duration out as far as possible in order to be able to capture more of the price appreciation. And conversely, you want to bring duration shorter when you think interest rates are going higher. So that's interest rate decisions. In terms of credit, this is another way that we can, another strategy we can employ in order to manage bond portfolios. And what I mean by credit is that it's essentially deciding what types of bonds to buy. So there are bonds that are issued by federal governments, like the Government of Canada. There are bonds issued by the provinces, by cities, and by companies. And you receive an extra yield, a bit of an amount over a Government of Canada bond every time you decide to buy a bond that has a slightly higher risk profile. So once you move out of that risk-free bond, government bond, you should be compensated for taking on more of that risk. And that extra yield that you get relative to a Government of Canada bond is known as a spread. So federal governments have the most taxation tools available to them. And corporations at the other end of the spectrum have no tax base. They rely on their future profits and their future earnings in order to pay back not just the principal, but also all the interest payments along the way. And so we would expect to get a higher and higher coupon or a higher and higher spread for owning bonds that have a little bit higher risk in terms of default, for example. And you can even take that one step further into high yield bonds. And these are bonds of corporations that might have somewhat shakier balance sheets or whose businesses are very attuned to the business cycle, for example. So to give you an example of the relative magnitudes, you can think of 10-year bonds. Bonds issued by the Government of Canada today give you back a coupon or a yield of around 1%. If you were to buy a bond from the province of Ontario, that might give you 1.5 or 1.6%. And then a bond of a company in, for example, an investment grade Canadian bond in a very secure sector like BCE or TELUS, these would give you a yield of, for example, 1.8 or 2.2%. And then if you were to move further into high yield bonds, an example might be Kraft Heinz in the US, and those bonds might return something above 3%. And finally, I don't want to forget that there's actually a component as well, that is equities in the income fund.
Yes, Carolyn, maybe I should just pipe in here because our fund back when we started in '07 was quite unique, and we collaborated with Connor Clark and Lunn when we were designing the fund, and we wanted to give you and your team one more tool, which was back then it was royalty trust, income trusts. You may remember those. Now it's dividend paying stocks, and so call it a quarter to a third of the fund is in those stocks, depending on how you guys feel that what the weight should be. And it's really it's a very good inflation fighter, and it does increase the volatility a little bit, but we think that's very manageable. And then really we set it up back then to make the fund a bond beater, which over its history it absolutely has done.
You know, Tom, this brings me to the next question. You know, the low interest rates, as Carolyn suggested, is wonderful. If you're a borrower with mortgage rates, you know, as low as 1.5% to 2%. But, you know, tools or no tools, it's still challenging for investors. You know, with bond yields so low, should we be owning any bonds at all?
Well, you're right about the appeal, Lori. It's I use that expression all the time. If it's a great time to be a borrower, then it's a lousy time to be a lender. And as Carolyn's told us, buying a bond, buying a GIC, those kind of things, you are lending money to somebody. So we have been very upfront about this with our clients really at the last year or two, that returns from the fixed income side, as good as Connor Clark and Lunn is, and as much as they will use those tools, are going to be pretty modest. And there could be another year like this year if rates went even lower, but as we all know, it's getting close to zero now. So I think we have to expect more modest returns from this side. So which, to your question, should we then still own bonds? And we're pretty definitive on that. We think balanced portfolios should still own bonds, and it's for one reason really, and it's diversification. I mean, we always are looking for something that will sort of counteract the volatility of stocks. And when stocks are going down, what can we own that will at least hold its value or go up? And the best diversifier we found, and better than anything really, is high quality bonds. And so that's really why they're there. They're there for defense, not offense.
Thanks, Tom. Carolyn, maybe you could go into more specific detail on some of the bonds that we own within the fund and how the income fund is positioned today.
So we did speak of two different ways to manage portfolios, two different strategies, interest rates and credit. So on the interest rate side, we are starting to see longer term interest rates rise. And at the same time, shorter term, medium term interest rates like 2 years or 5-year interest rates remain relatively unchanged. In fact, quite well anchored, close to 0%. And that is being reflected in our portfolios, where as we anticipate longer term interest rates to rise, we will help to guard against any decline in the value of bonds. On the credit side, similarly, we have held on to a larger than usual weight in corporate bonds for the better part of last year, actually, after the volatility that we saw in March. So the value of those corporate bonds declined in that volatility. And so we were able to purchase some of these corporate bonds at very favorable valuations for the portfolio, and we continue to hold on to those today. However, we do these purchases in companies that have very solid balance sheets and very, very stable earnings. And these are companies that tend to do well in volatile periods. And one example is telecommunications. We have all been at home more, and we've depended on that connectivity for work and as well as entertainment. And so bonds, for example, at BCE or TELUS are two examples of bonds that we hold in the portfolio. Banks are another type of bonds that we hold. And we also have grocery stores, so companies such as Loblaws. And these bonds have helped the portfolio achieve some return, both through its additional yield, but as well because of the appreciation that we've been able to achieve between the March-April timeframe to the end of the year.
Tom, the Income Fund is one of the funds that is owned in the Founders Fund, which is our balance fund, and many of our clients own the Founders Fund. Can you update us on the Founders Fund and how the income in particular is positioned within it?
Sure, Lori. Just a reminder, the Founders Fund is one that we're always trying to find a balance between the best return, but also protect against the downside. And so it's designed to have roughly 60% stocks and 40% fixed income. And one way we're dealing with these low rates on the fixed income side is we are owning more equities. We took advantage of the market decline in March and brought our weighting up quite significantly, and have stayed there despite all the uncertainties around COVID and debt levels and all that's going on in the world. And people have asked, why do we still own more stocks than is our target? And the reason comes back to what is the topic of this segment is interest rates. As interest rates go down, they make the future returns of bonds look worse, but they benefit stocks in a number of ways. One is the companies that we're investing in, their profitability gets better. They borrowed a little at a lower rate, and presumably lower rates stimulate economic activity, which helps revenues. It's also for the dividend paying stocks, their dividend starts to look much more attractive when rates are at 1% versus when they're at 4 or 5. And so just an example, if you have a stock that yields 2.8% 5 years ago, that wasn't considered an income security. But today, with rates where they are, income investors are looking at that. So that helps stocks. But the biggest swing factor in why interest rates have impact stocks and have kept our weighting where it is because the value of stocks go up. When we do our calculations, our analysts do our calculations in valuing a company, they're looking at earnings, 3, 5, 10, 20 years out. But somehow you have to bring those future earnings back to current day dollars. And they do that with a discount rate, which is higher than interest rates, but it's trends about the same direction. So as we've used lower discount rates, and other investors in the market have, you see that companies are more valuable than they were before. So that's given us something to lean on in face of the COVID uncertainties and the debt levels, et cetera. And so we've kept our equity content up. Now, the other part of the portfolio, so is fixed income, which is, albeit less than 40%, as it is designed to be. And what we've done with that is the majority of that is indeed invested in the income fund. And the income fund is our largest holding in the Founders Fund. But many of you know we've hedged our bets a little and kept some cash aside and literally had the money just sitting in cash. Doesn't earn much, I know. But again, it's a defensive tool that we have in the Founders Fund. And it's just a little bit of insurance in case rates go up. And catch us off guard, that the fund will be able to handle that better. So on the fixed income side, Lori, we're mostly income fund, but we do have some allocation to cash.
As Tom suggested, interest rates won't stay low forever, and some of our clients are starting to ask us about inflation. Carolyn, should rising inflation be a concern to our clients, and what's your outlook?
Inflation is an important issue for bond markets. It is important, really, I think, at this point to separate between what we believe is a shorter term impact of inflation, so maybe over the next 12 months, versus a longer term view for inflation, thinking more in the 2-year to 5-year time frame. And so over the shorter term, we are not very worried about inflation. And I know that it's often a little bit counterintuitive or difficult to really believe, knowing, as we all do as consumers, that prices seem to rise. But yet, in aggregate over the next year, we believe that there is not enough pricing power out there for companies, and that we will not see sustained generalized inflation that would create concerns for the marketplace. In fact, companies, we believe, over the next year will in fact be competing for the consumer's dollar. Beyond that, however, we do see forces that will create inflation. In particular, the enormous effort by our country's policymakers, and here I mean federal government, the provincial governments, as well as central banks, the effort that they have put forth to generate robust economic growth should in fact bring inflation back to this country. And we believe that this is going to be the case over the next few years. And this is important for the portfolio. This impacts, inflation impacts bonds because yields will go up with inflation. Investors will demand that we gain an increased return to compensate for inflation, and recall that prices of bonds are inversely related to interest rates. So inflation is not good for bonds. But because of its importance, we are attuned to it, intensely so, in fact. We are carefully assessing the forces of inflation back and forth. We are mindful of the risks of what policymakers are doing, the views of the economic cycle, and we're focused specifically on managing risks related to interest rate movements.
You know, Tom, inflation is a big concern for bond owners. What would be at the top of your list?
Oh boy. I think number one in a word would be complacency. And I mean complacency around debt and interest rates. And I think we the Royal, we have come to assume that rates will always be low. They'll never rise. Credit will always be available. You'll be able to call your banker in a second and get an extension on your line of credit or whatever. And that the issuers of bonds won't default. And I think, Carolyn, you and I know that that isn't necessarily the case. There are cycles to this. So I think the worry is that this complacency leads to people taking on too much debt out there in the community. I've said for a while, Canada is a poster child for debt. We know mortgages, we know line of credits, we know car loans, we know car leases, etc., credit cards. But there's that issue. As far as investors go, what I've observed is that not Steadyhanders, but other investors have moved out the risk scale, and they've, to try and get the yield they had 5 or 10 years ago, they're owning riskier bonds. Carolyn talked about some of them, high yield bonds, maybe private debt, structured products, even preferred shares. And there's nothing wrong with any of those asset classes. But if your fixed income component is all in those riskier kind of assets, it doesn't provide that diversification or that buffer that we think balanced portfolios should have. So how do we do it? Well, we do, you've just heard how we do it. Connor Clark and Len is very disciplined about allocating capital to different strategies. There's always a big chunk of high quality bonds in the portfolio, and we, pardon the expression, we take our shots at a high yield or some other things when they're valued very attractively. So Lori, I think I do worry about the complacency we have in society general today about debt and interest rates.
Thank you for your time, Carolyn and Tom. For those of you who have questioned why you own bonds in your portfolio, we hope today has been a reminder that the diversification that Tom spoke about, the income, albeit low, and the protection that bonds can offer still can play a key role in your portfolio. This session was primarily focused on interest rates and bonds, but my partner Salman will be hosting 2 sessions where he interviews our 4 equity managers. As always, if you have any questions, please don't hesitate to reach out to us, and thank you for viewing.